Hello there! If you're a business owner or an investor here in the UK, you know how tricky it can be to pay yourself in the most tax-efficient way. So, let's get you some clear answers on UK dividend tax for the 2025-26 tax year.
This whole discussion has been put together by the experts at Pro Tax Accountant, and we're going to focus on one key question. A question that, honestly, affects millions of us, especially with how often the tax rules seem to shift.
And that big question is this. With all the changes we've seen, how much dividend income can you actually take home before you have to pay any tax? You know, the real answer? It might just surprise you.
Okay, let's look at the history here, because the story of the dividend allowance, well, it's a story of a pretty steep drop. Not that long ago, back in 2016, it was a pretty generous £5,000. Fast forward to today, for the 2025-26 tax year, and it's just 500 quid. I mean, that's a 90% drop. It's no wonder so many people have been caught off guard.
But listen, that £500 figure, that headline number, it's not the whole story, not by a long shot. If you understand the bigger picture, that's the real key to unlocking a lot more tax-free income.
All right, Section 1, the £500 headline. Let's break this down first and see who this is really hitting.
And the impact? It's huge. We're talking about a record 3.7 million people who are expected to pay tax on their dividends in the next tax year. To put that in perspective, that's over 1 million more people than just a couple of years ago. So this is not some small niche issue. It's affecting a massive number of us.
But here's the secret sauce, the crucial bit that so many people miss. Dividends are not taxed in a vacuum, all by themselves. You have another much more powerful tool in your tax toolkit, and that's your personal allowance. And believe me, it completely changes the game.
So let's move on to Section 2, your tax-free building blocks. This is where we build out the full picture. I want you to think of your tax-free income like two separate blocks that you can literally stack on top of each other.
Okay, so on one side, you've got the real heavyweight champion, your personal allowance, sitting at £12,570. This is your main tax shield, and it works against any type of income. Then, in the other corner, you have the much smaller £500 dividend allowance. This is a special little extra that gives you a 0% tax rate just on dividends.
Let's be absolutely crystal clear about this personal allowance. It covers the first £12,570 of pretty much any income you bring in. Salary, profits, you name it. And, this is key, if dividends are your only source of income, then this entire amount can be used to make them completely tax-free.
And then you've got the dividend allowance. The best way to think of it is like a small, extra protective shield. It gives you that 0% tax rate on your first £500 of dividends, and it sits right on top of your personal allowance.
So, what happens when you put them both together? Well, you take your £12,570 personal allowance, you add the £500 dividend allowance, and you get the real number, £13,070. That's the maximum amount of dividend income you can get completely tax-free if you have no other earnings. A whole lot better than just £500, right?
Okay, moving on to Section 3, salary versus dividends. Theory is great, but let's put this into practice and see how it actually plays out in the real world with a couple of really common scenarios.
All right, first up, let's look at Sarah. Now, Sarah doesn't take a salary at all. She just receives £20,000 in dividends. So her £12,570 personal allowance kicks in first and covers that initial chunk, tax-free. Then her £500 dividend allowance shields the next bit. After all that, she's only paying tax on what's left, which makes for a much more manageable tax bill.
Now let's look at James. He uses a really common strategy for company directors. He pays himself a salary that's exactly the same as his personal allowance, £12,570. So that's all tax-free, but it means his personal allowance is now completely used up. So when he takes his £15,000 in dividends, he can't use it there. But he still gets to use that £500 dividend allowance to shield the very first slice of his dividends from tax.
Okay, so you might think you've got the rules down. But knowing the rules is one thing. Avoiding the traps is something else entirely. So in Section 4, we're going to look at some of the most common tax traps that can land you with a nasty, unexpected bill. Listen up, because this is probably the biggest, most costly trap of them all. People assume all their dividends are taxed at that nice, low, basic rate. But it's your total income, salary, dividends, everything all added together that determines your tax band. The second your total income tips over that £50,270 threshold, the tax rate on any extra dividends doesn't just go up a little bit, it basically quadruples. It's a massive jump.
And you know, it's often the little things that trip you up. Did you get a few quid in dividends from an old investment account? Yep, that counts. And pushing your total income up can trigger all sorts of other problems, like the high-income child benefit charge, or it can mess with your pension planning. You really have to watch every little detail.
So, with all that in mind, how can you figure out where you stand? Let's get into our final section. Check your own position. We've got a simple checklist to help you get a really clear picture.
It's a really simple 4-step check you can do. Step 1, figure out exactly how much of your personal allowance you've already used up, probably on a salary. Step 2, add on your £500 dividend allowance. Step 3, and this is the critical one, work out what your total income tax band is. And finally, step 4, apply the correct dividend tax rates to the right portions of your income.
And this chart really shows you why that last step is so important. Look, once your allowances are gone, you start off paying 8.75%. But just look at that enormous jump to 33.75% the second you cross into that higher rate band. Knowing which side of that line you're on, well, it's everything.
Okay, so let's boil this all down. What are the absolute key takeaways? Number 1, your dividend allowance is tiny, just £500. 2, your £12,570 personal allowance is your most powerful tax shield by far. 3, that £50,270 income level is a tax cliff edge. 4, watch out for those knock-on effects like the child benefit charge. And 5, remember that even a small salary can be vital for things like pension planning.
And that really brings us to the final question, the one you need to ask yourself. Now that you see how all these pieces fit together, are you absolutely sure that your current dividend strategy is as tax efficient as it possibly could be? Look, everybody's situation is different, and the details really matter. So if any of this has made you think twice about your own strategy, the best thing you can do is get some personalized advice. We'd really recommend getting in touch with the team at ProTax Accountant. They can look at your specific circumstances and make sure you're on the right track.